Hey there, it's Mike Langford. Welcome to the Augmented Advisor podcast, brought to you by Blue Leaf. On this episode of the show, John Prendergast and I are joined by Dan Egan, the Director of Behavioral Finance and Investing at Betterment, for an expansive conversation on a variety of behavioral finance-related topics. We tackle things like the impact of free financial products and services on the wealth management industry and how it affects our end clients. We also attempt to answer the burning question of, if a computer does it, can we really call it financial advice? And for you action junkies, we'll be throwing in a few high G maneuvers as well. So buckle up. This is going to be a great show. Before we get started, please take a moment to subscribe to the podcast on Apple Podcasts, Spotify, Google, Amazon, the YouTubes, or wherever you like to podcast jam on. And if you have a question or a suggestion for a topic or a guest for the show, please feel free to reach out. Shoot us an email at podcast@blueleaf.com. Or swing by the website or hit us up on the socials. Blue Leaf, John, and myself, we're all active on LinkedIn, Twitter, and pretty much just about everywhere else. And we're really easy to find. Okay, let's get to our conversation with Dan Egan. Dan Egan, so fantastic to see you. Welcome to the Augmented Advisor podcast.
Thank you for having me.
Super excited to have you on the show.
I'm looking forward to it too.
I feel much warmer than you look because as a fellow bald man, I could identify when you and I were talking before we could record. I'm like, oh, you got the hat on. It looks awesome, by the way. I'm a big fan of a strong hat game. And
yes, indoor hats specifically.
Yes, exactly. We're getting very close to that time of year here in Austin where it starts to get to below 50 occasionally. And I will probably up my
oh, come on.
Yeah,
that's shorts weather, man.
I do wear shorts pretty well into like December usually, but and we're in some unseasonably warm weather. So anyways, not
this is my mid-30s New York City hat.
Yeah, okay. Very cool, very cool. I would be having a hat and something very warm on top as well. Well, we have been looking forward to having you on the show for quite some time. And in fact, I've been like a crazy pest. I was pinging you on LinkedIn and email and just trying to get you on the show because so fascinated by this concept of behavioral finance for financial advisors. And, you know, in this session today, we're talking about a lot of different topics as it relates to behavioral finance. But I thought it might be a smart way to start this thing off would be having you tell us what is behavioral finance and why is it important for financial advisors to understand this as they go about their business?
You know, I think the way over the years, I think a lot of people get introduced to behavioral finance early on with this sort of like, oh, people are so irrational. Like, look at these mistakes. Look at these decisions they make that don't make sense. Aren't we all just like, you know, like fallible, you know, fallen angels who just can't get their stuff together? And, you know, like when you're, I don't know, like when you're a college student, that's kind of cool. And you get to like, you know, like, haha, economics isn't quite right. But like over the years, I think it's really refined to me to like, you and I have an operating system inside of our head that we actually are learning more and more about. We know like when it does really well at things, how to work with it, when it doesn't do well, when it needs some guardrails or a different approach in order for it to work well. And part of that is just learning about yourself as a human being over time. All of us learn over the course of experiences about, oh, you know, there's that thing I was so upset about for a while. And now when I look back at it years later, it was nothing. I don't care about it anymore. So on. That wisdom kind of like translates into you having more experience and not being so worked up about new challenges you might face. So where I'm at now is that you know, you can study how people make decisions and how they feel about those things, how they engage with them. You say, I'm here to use that knowledge to help people make better decisions, be it in terms of numerically or like with money or that make themselves happier or that cause a little bit of introspection. You know, like we deal with this great thing. Money is this sort of universal, you know, like commodity of like, I can change it into like somebody cleaning my house or an insurance product, whatever it is, which is great. But it's also this really weird thing because of that, where like we've quantified and monetized and put into a unit life. And what, you know, like we get paid for hours of our time and our expertise. We consume hours of other people's time and expertise. So a lot of it's around understanding the way our brain works well in those situations, where it goes off the rails. And part of what I've really grown into is understanding how to the design of technology, be it software, sometimes hardware as well, how the design of those things encourages good decision making or bad decision.
It's pretty fascinating.
That's a great description. And, I love how it's centered on decision making, right? Because it's sort of, that operationalizes the concept, right? And how we as humans make decisions well. And I think also optimistically how we can improve them. And you wrote a post about this a while back, about low cost and that being better than free, right? Sort of the impact of free pricing, or the notion of free and how that moves barriers out. But there's some hidden costs, and I was wondering if you could talk a little bit about that concept, generally how you described it for consumers and how that might impact us as advisors, in terms of free trades or free funds and impact how they do business.
Sure. I think there are two main components to that. One of which is about the psychology for all of us to be aware of and what free does to us. And then the other one, which is much bigger, is the sort of second order effects of there being free goods and services in society. So the first one, the psychology of free. This was very interesting to me. I got to go down a little rabbit hole. So generally speaking, I'm going to use the example that I used in the post. You're walking down the street and there's some kids selling chocolates, and they've got a really nice like Lindt chocolate. It's kind of fancy, nice wrapper, and they're charging 15 cents for that chocolate. And they're little Hershey's Kisses, and they're like, oh, and those are a penny. So whichever one you want. And you say, well, the Lindt chocolate looks pretty good, and if I'm going to spend some money, I might as well enjoy it. And so generally, about like 80% of people in that situation will go for the Lindt chocolate. 14 cents price difference between those things. And if what you do then is you say it's later on in the day, the kids are like, wow, we got a lot of these Hershey Kisses. How are we going to make these things move? You reduce the price of both of those by 1 cent. So now the Lindts are 14 cents and the Hershey's are free. And when you do that, all of a sudden, 85% of people start taking the Hershey's Kiss when they're offered that, right? So same price difference, you're paying 14 cents more for the Lindt, but all of a sudden, the Hershey's Kiss is way more attractive. Why? What just happened that shifted something so strongly in terms of which one you would prefer? And you start thinking about it, and it's like, well, number one, just practically, I don't need to pay you. I don't need to even check and see if I have change in my pocket. It's easier, it's simpler. Like there's no credit cards, there's no of that like friction that comes with having a transaction at all. That's valid. There's something pretty important. The second is that there's no trade-off that happens in like if I think of the Hershey's Kiss, there's no like, is it worth it? Is this something that I really want? Is this something that I'm going to value? So when something's free, because we are not giving anything up, and the act of considering giving something up is very powerful in our minds. This is where ideas of loss aversion come from, is that like giving something up, having losses, we feel them dramatically stronger than the same amount if we were to gain it. So when we sidestep that, oh man, I have to give something up in order to get something else, when we go around it using free, we don't think as much about, is this thing that I'm getting worth it? Because I'm not, in theory, giving anything up. And so you can think about social media apps are free, right? They don't cost me anything. But what I give up is my time and my attention and a little bit my sanity. If you go to somewhere that's serving sort of free food, you'll eat more of it, which doesn't cost me any money, but definitely costs me, like inches around my waist. So free is
and those things really hurt, Dan. Those inches, they're very uncomfortable.
They have long-term negative impact on my knees.
And this in the startup world, when you talk to entrepreneurs about this who are thinking about free business models, this issue is known as the penny gap, right? So it's an incredibly fascinating hack for the way that people make decisions and how it kind of short circuits a lot of that evaluative, mechanism but you were starting to get into some pretty interesting stuff about the fact that free isn't really free, right? There's a bunch of costs implied. So, keep going down that road.
Yep. So it's a very common saying amongst tech people that if you are not the customer, you are the product. You are what's being sold. It might be your time, your attention, but they're not charities. These are companies looking to make money somehow, and they will do that. They'll just get paid from somebody else who's their actual customer, the person who they actually really care about because that's the person paying them. So, social media apps, it's probably advertisers in some fashion, and brokerage apps where it's pure pay for order flow. It's going to be the market makers or liquidity providers who are the real customers who they get to come into the room and say, you know what we really want is we want this kind of transaction. We would love it if we could do more options trading because the spreads around those are a little bit. So the not free component both has like this sort of second order thing, which is that when you're not the customer as the person using it, you don't have a strong voice at the table about what's good for you and what's good for the design of the product. Because what happens to you isn't going to necessarily increase the revenue of that company or the profit. So in the case of brokerage apps, which I happen to just be a little bit closer to, like imagine somebody came in and said, hey, I have this great idea for helping people be better investors. We're going to give them better feedback loops about what kind of trades they place that are successful, how their turnover worked, et cetera. Let's run it for a little while. And they find that change, like making people better informed or better investors, learning faster, reduce the turnover, reduce the number of trades, and maybe people started using more liquid securities instead of more illiquid securities. Now the brokerage is going to say, no, this was not a successful thing. This clearly reduced the revenue that we were making off of customers. Whatever this is, let's stop it. We don't want to do that. We're going to not invest in something that costs us money. So when like you're not paying, you can imagine saying like, I want, and incentives in financial markets are very, very tough. I think even for advisors, figuring out the right way to say like, I have skin in the game so that I'm successful when you're successful, but I also have to do work and I have to get paid for some like minimum amount of work that I'm doing. Figuring out the right incentive is tough, but the more that incentive is like hidden from the person who's notionally the customer and is actually kind of being sold in some way, the less awareness you have about like what could you be getting if you were the customer. How am I being charged? Like if I get charged, whatever it is, $8 a month from Netflix, I'm getting charged $8 a month from Netflix. I know that. If I'm not getting charged, I don't know how much I'm kind of implicitly paying in time, money, or worse service.
Well, you almost give up the right to ask, frankly. It's like you're using this product for free. It's none of your business how we're making money over here. Yeah. Quick question on this to get your thoughts, kind of follow up on this free topic is, this is the first time we're in the first era, if you will, or early stages of an era in which financial consumers are having free stuff like they've had in other, like, so if we've had free social media since the dawn of its inception. So you articulated some of these other areas where people are getting some free stuff and they are effectively the product in that scenario. But we're entering the first wave of where a client might walk into a financial advisor's office and have some assumption that some stuff's going to be free here because, they got started with some, free funds, a free online advisory offering that was, a robo-advisory offering or what have you. And so they may come in with a conception of like what this thing is going to cost. Whereas, historically, we've always had fees associated with financial services, right? And they've usually, there's at least been some that you see, and we know about some of the hidden ones too that are baked into funds and so forth. But what are your thoughts on how an advisor should kind of start thinking about adapting to that new world?
I think obviously the first part is what you just said, which is just being aware of where consumer expectations are and those reference points. And in some ways, leaning into that, right? One of the elements that comes up when something is free is I think people also understand, like, I did not pay anything for this, so it is not a premium product. And the more that there's a sense of luxury is not quite the word. I think premium is probably the best way of sort of saying like you can get a free product without a doubt. I'm worth more than that. my time is worth more than that, and I want some kind of a premium offering. And leaning into that conception of, and I think this is very true, in theory, I could change the oil on my car myself, right? But like, I like to think, and I'm probably pretty arrogant in this, I like to think that my time's more valuable than that. I like to think that somebody else can probably do it faster and quicker and more effectively than I can. And therefore, I can go spend my time doing something I'm better at than them. That's, simple,
Yeah.
simple the way the economy works. But the more you lean into that saying sort of, you will totally get a free experience out there and you can do it when you start valuing your time, when you start valuing your attention, when you want somebody who is going to help you make more valuable decisions. We're ready and waiting for you. Feel free to graduate to something like
Yeah. Yeah. It's fascinating. So I always have the, what's my time worth equation that's going on in my head. And I also have the, what are the consequences of me doing a terrible job? What if
yeah.
I screw this up? Like, is it a big deal? Like, no big deal, I'll buy a new one. Or is it, oh crap, like the whole house is flooded. I think I should call a plumber instead. I don't know what the heck I'm doing when it comes to plumbing. Right?
Oh yeah.
That type of stuff. Shifting gears, that I think that's on a related topic. When we were at our prep call, you asked a really, it was just one of those questions that just pops out and sticks with you. It was, if a computer can do it, is it advice? You asked, like, that's a really interesting question, right? Because we are, just as I was describing there's a lot of services now, online solutions that a financial consumer can go use or a financial advisor can use, and it gives you a recommendation based on the data you gave it. Or if you give it access to your accounts, you're starting to see, especially on your banking apps, little triggers, event-based triggers that pop up and say, hey, Mike, would you like to, you've got some excess cash, would like to move some of that money over into an investment fund versus like having it sitting in cash or whatever. Should we consider this advice? What are your thoughts? Where have you come down on this? So that if a computer does it, is it advice?
So this is absolutely like an evolving over time type thing.
Yeah.
And where I'm at right now, which is definitely a new and a funny way. I'm still feeling it out. Is that advice is a liability? Advice is somebody taking on the liability of saying, "This is going to be right for you. This is going to be good for you." And the reason for that is that I think about this sometimes. There's I call up an advisor and I'm like, "Hey, what should I do?" And I don't even know this, but the advisor goes over to the computer and looks at the same calculator and says, you should do X. And I'm like, cool, this is on you, right? Like I reserve the right to say, this is your responsibility. That's literally what I'm paying for you for. And there's a very old behavioral finance paper that says financial advisors are effectively what he calls money doctors, which is that in theory, the person knows that they need to exercise
Yeah.
and eat well and so on. They want an authority figure who can talk to them about the specifics and the jargon of it and so on. But at some level, there's just a side piece of accountability and also liability of saying so this is the right thing to do. Like you're responsible for saying to me, this is the right thing to do. It's not the calculations exactly that matter. It's the liability of if this is wrong, whose fault is it? And more and more, I've come to think of it as you can do the same calculations, you can give the same advice. The question is the counterparty going to stand up and say yeah, if this is wrong, I will bear the consequences of that. I'm in some way responsible for a good or a bad outcome here. And a person who is not a true advisor, I'm not using it necessarily in a regulatory sense, but somebody who gives advice will probably say, oh, no, at your own risk, whatever you think, I'm playing in Microsoft Excel here. Who knows what's going to happen? But somebody who's a real advisor will say listen, I don't know the future, but yeah, I'm happy to say if this goes wrong, you can come and yell at me about it.
Yeah, so the advisor is is the steady hand at the wheel, as I always like to think of it, right? I'm going to help you with the emotional ups and downs of this process here. And in the case of if we're bringing a computer generated asset allocation recommendation into the fold as an example, sure, we can roll with that. But if the model doesn't look right for you and your risk tolerance, or something's going off the rails a little bit, or your life events happen, I'm here for you, right? It's fascinating.
Yeah, I mean, it it feels a lot like it's an accountability engine on one side, right? But also, I think it requires, to be advice and not simply a recommendation, I think it requires empathy, right? And that for me is the dividing line between what a computer can do and what a human has to do. And I think for it to rise from recommendation to advice, it really needs to be paired with that empathy and understanding that a human delivers. And then sure, there's all the other mechanical mechanisms that we just talked about, and this accountability notion and liability, etc. But I think a big piece of this is feeling confident I am understood. And that feeling understood to me is a human interaction, right? It's and I don't expect I'll see a time when I feel understood by a computer. Really cool Hollywood movies notwithstanding.
Yeah. It's true though. Like we all can do that. We have the DIY stuff that we do, but inevitably you're going to have a question and you're going to want to talk to somebody. We've all had the scenario where we've wished we could actually talk to somebody at Google. By the way, I actually talked to somebody at Google earlier this week. It was kind of awesome, the customer service one, but I was paying for advertising stuff. Anyway, you've always wished you could talk.
You spoke to somebody in customer service at Google?
Yes, and they actually asked me for my phone number and called me. It was wonderful. It was great.
It's crazy.
I actually had to tell them, like, this was one of the best things that's ever happened to me all week. This is great. I talked to you. But see that delight right there, right? I got to an issue where I could not resolve it on my own. And no matter how many help FAQ things I went through or Googling, like who else has had the same error or whatever, there was no answer for me. I kept on getting the same result. I'd resubmit the ad. The ad would come back disallowed, and it would say that it was being disallowed because it was dealing with sensitive events and like this, whatever. So it was really getting challenging. And so I couldn't believe it. I sent a ticket in and somebody actually called me. It was amazing. But there were going to be life events for your clients as a financial advisor who, even if you're giving them somewhat of a DIY experience, at some point in time, they're going to run into something where like, I need to talk to somebody, right? Like a parent has passed away, I'm getting a divorce, or a kid, whatever's going on. I need to talk to somebody about, am I on the right path, or how do I deal with this situation? How do you, and I know you're not a strategist for like how financial advisors should run their business, Dan, how would you recommend that advisors go about packaging some of the computer generated advice to their clients, right? It's because, if you're an advisor operating now, you're going to use, computer tools, right? Financial planning tools and some of these other, probably some portfolio management tools, because it makes you more efficient. How would you go? What are your thoughts there?
Yes, there's a few things. One is that I'll tell a quick story and then try and extract some stuff from it. A good friend of mine who works as a financial advisor says that he probably, for any given client, he only really like adds value like 7 days a year. But on those 7 days, it's rather clutch that he is there to add value, because he has context, he has experience, he knows, okay, it's the month of December now. These are the moves how we're going to maximize the effect of our charitable giving while reducing your tax load before the end of the year in these specific ways across these account types, et cetera, et cetera. And the ability to be decisive and effective and clearly like communicated to a person at a specific point in time, such that they can make, I often think of them as like high G maneuvers in a short period of time. They got to change direction and they got to do it effectively and efficiently. That's very, very valuable. And it's like sitting there a lot of the year consuming and being aware so that you can be decisive. Now, I think, one of the kind of ways I also think about that is that that's great, but there's two ways advisors might interact with their clients. One, which is pure kind of financial planning. Like we get a little bit of spike of end of year, and definitely a spike March and April around tax times, and a bit of a lull through the summer. And then there's also a crunch and a congestion crunch of your time, anytime the market's going down and you have a lot of clients who you need to speak with. So one component of this thing about like, how do you plan and smooth out the parts of your interactions with clients that can happen in June or July. Right? Who's the set of people who you're like, you know what, I want to set up a meeting with you every June and July because you haven't like gone off into the woods somewhere and you'll be available to talk to. But that means that I'm not dealing with those same problems with you in April when it's going to kill me, or at the end, the mid-December when it's going to kill me. And I think that smoothing of the relationship conversations with the client, the check-ins that allow you to say like, are we on top of everything? Does this still make sense? Like, is this still the salary or the thing that we have to budget for before the end of the year? Allows you to have what I think is very important, which is the context, so that, and I use a tax preparer, and I'm absolutely guilty of this thing where I'm like, hey, really sorry, I've got 2 weeks to make a very important decision. Can you tell me the answer, please? Here's the information that I think is relevant. So that like when that happens, you're not like, yeah, let me go read a bunch of notes and try and get back on the same page, which might take me a while. So there's a component of like gardening or like maintenance that's like keeps the knowledge about the client up to date and relevant, so that when they come in with a kind of like high G move they need to pull off, you're ready to really do it for them effectively. You're not spending a lot of time like updating models.
Yeah.
And that's proactive on the advisor's part.
I love that proactive nature of it, of seeking people. And the other thing was that you mentioned was smoothing. That got my brain going. Like, I love the notion of like, hey, look, you're gonna have some peak times. Like, maybe you try to head off these things either earlier or later in the year, or I guess later in the year, but earlier before the end of the year. So that someone's like, oh yeah, let's do a little bit of tax planning now in July versus waiting until December 15th before we start thinking about some of these things.
Yeah, it's funny. In our work at Blue Leaf, we actually see this pattern play out pretty frequently across most of our customers. The advisors who are growing fastest and have the happiest clients are the ones who communicate the most frequently, and that's true whether it's automated or human. But it's usually some combination of those two things, so that those sort of transactional communications, those update communications, those things that are not timely or happening really frequently in small chunks. And then the advisor has context available. But I think another critical piece of that is what you were talking about in terms of trust for these high G maneuvers. All of those touch points are little trust builders that sort of prep someone to be ready to go, because, to the point we were talking about earlier, they feel understood. And so if I feel understood, Dan, you understand me, and I've worked with you for a while now, and you say you got to make this change. I know it's uncomfortable, but you got to do it, and you got to do it now. I'm going to say, Dan told me to do it. I believe him. Let's go. It just becomes much lower friction.
There's a very important insight there too, which is, it's called the Augmented Advisor, right? But what part of the advisor are we augmenting? And we are not trying to make it so that the advisor can go and place more trades themselves, or rebalance themselves, or look at a Bloomberg screen more themselves. One of the very common models that happens, so like you go back to, I think, right before Lotus Notes came out, accounting software, like people, there were those Excel spreadsheets, but they were paper. And accountants were the people who went in and just like manually updated all of the numbers. And so imagine being an accountant and seeing the first, Microsoft Excel, but it was Lotus Notes, and it's like you change this number and all of the rest of them change immediately. And you go, oh shit, I'm out of a job.
Yep.
That's literally what I do. I do that like 40 hours a week. My gosh. But what actually happens is that you understand, you have a mental model for how that stuff works. You get, as long as you like adapt to it and accept this, you get shoved up the value chain. You are not going to make a living calculating things anymore. You are going to make a living running scenarios, talking about possibilities, having that context and knowledge. So I think part of what you're saying that's very important is like you have to try and let yourself or push yourself up the value chain, away from things like managing portfolios, away from things like staying on top of, I don't like things that a computer is really good at, rote, routine, ongoing maintenance and stuff that's like pretty programmatic. Like no client's like, wow, you monitored my account. Like thanks so much. They're going to say like, you understood the situation my family was in. and what we wanted and what we cared about, and you helped us find a path that made sense for us to get through it. And that is not something you get by staring at a Bloomberg.
Mm.
And I think what's phenomenal about that is there's also a behavioral aspect to discuss for the advisors themselves, which is how did they let go? How did they get comfortable letting go of the thing that they've always done? You know, we certainly have this conversation on a regular basis when we're talking about automation of those kinds of rote things that a computer can do for them on their behalf. And, you know, honestly, in some cases, the client can't tell the difference whether the computer's doing it or they're doing it, but it frees them to have those higher value added interactions or you know, move up the value chain, as you said. How do we help our listeners get out of their own way here?
It's really, really hard. One of my old managers used the expression of giving up your Legos. Like, it's this thing where like you've gotten so good at
I'm
it,
not
and you
doing
love
that,
these
Dan. No
things, and
way.
you're like great, and you're like, okay, great. You know, it feels like there's some actual like life development principle, which is like when you're good and competent at something and you enjoy doing it, that means it's time to move on because you've hit your kind of like competency level. And like, yeah, it feels great to do it because you're really good at it, but you're not challenging yourself. You're not
Mm.
like adding maximum value because somebody who is still learning it probably could get in there and do really well too. It's a great question. I think it's the first part of it is recognizing that tendency to gravitate back towards where we're comfortable, the things that we enjoy doing. And part of it's saying like, if you really enjoy that, that's okay. Like, don't say you're not allowed to enjoy your life and your job and like, you know, this component of it. Like, you know, I know some advisors who love writing out their weekly commentary. You know, like I don't even know if the clients really care about it, but they love writing it out. That's part of what they enjoy. So like, go ahead and do it. Be sensitive. Here. One of the things that's really tricky is there is a pattern. You have to think about noise, the noise of a feedback loop versus like the fidelity of it. So an example is you send out your weekly, you know, like market update type, and you'll probably hear back from the clients who like reading it and enjoyed it and wanted something to talk about. So you're going to get a very natural positive
Mm.
feedback loop there, right? Maybe if you have, you know, like an email client, you might see some unsubscribes. The client's probably not going to email you back and be like, this was dumb. Why did you waste my time with this? Please don't send it to me again. You're not going to get a noisy negative feedback loop. You're just going to get a noisy positive. And one of the things that I think over the years I've come to say, like, how do I set up feedback loops that are giving me both of those at a high level fidelity? How do I hear the things that are not going well, even if it's uncomfortable for people to tell me those things that they wish I was doing more? A friend of mine helped me set up a thing where like there's an anonymous feedback for Dan thing that like anybody can do it. Heck, my wife can do it. You guys could do it if you wanted to on my website. And it's just
Mike,
like,
write that down. We're doing it.
yeah, I'm going to go and check it later
Listen, this
and
guy
just
was.
hit the trash button on everything. But I think that, you know, like setting up sort of thinking about like, okay, suppose somebody didn't like this thing that I'm doing. How would I know about that? And setting up feedback loops for yourself in advance of that to kind of be like, how am I going to track this? How am I going to think about if this is going well or not? Not just for me, but also for my clients, so that I'm sensitive not just to the positive, noisy feedback, but also the silent negative feedback.
Well, and that's a kind of a, I don't know whether you'd call that a type 1 error, but there's also the type 2 error. We see this really frequently where a single complaint and they'll abandon a practice for all 150 clients. And you, that overinterpretation can really hurt advisors. We've found. So I'm curious there. Any suggestion for how to zero in on the right response to that sort of feedback?
Can you give me an example of like the what the client is saying?
Sure. So I send out an update and I get a complaint from one of my clients about the information I sent or what have you, but I've sent it to 150 and one out of the 150 complains. I become concerned that my clients don't like this. And so I shut it down.
Yep.
So we've seen that behavior.
The first is definitely to think of like, is this a opportunity for me to kind of like differentiate experience? The first thing I was thinking about is like, do I have to have a one size fits all experience for something? Or is this something that I actually want to like lean into there being different interest groups, like for lack of a better, different interest groups, right? I am part of many different Slack spaces, and they're great because they're by interest. There's overlap between people, but like there's no like me and this person. It's like we're here to talk about woodwork. And rather than sort of interpret that as like, well, I have to change everything in my practice to be like the same for everybody, saying like, great, like obviously some people don't like whatever was going on in this update. Is there some way that I can say like people who are interested in it should be able to subscribe and like manage their own settings themselves? And obviously if you get a lot of your clients not subscribing or unsubscribing to a component of your communication or whatever it is, that's a very strong signal. But I do think allowing differentiation also feels really good from the consumer's point of view, because number one, I have agency and control over my experience. I might love what I just had this with an app I was using where like, think about Uber Eats. Like I really want to know that the food's on the way. I really do not want you to tell me that I can save $3 on a meal again, right? Like, please let me turn off marketing, but I really want to keep the whole like, like I value the like your delivery's on its way type stuff. So allowing people to have that level of control, it's great. It means that you don't have to like think about micromanaging your outbound stuff yourself. And it gives them the sense of like, I'm getting what I want from this relationship in the right way. And every once in a while you can go and be like, what are the other things I might be missing in here? What are the things that this does that I might not be getting full benefit of that I should?
I love the idea of the differentiated experience and thinking about your clients, your book, as not a homogenous mass, but as 100, 150, 1,000 individual points. And if some percentage of them opt out of some experience you've offered, great. They've just told you they're essentially in a different segment. And if you're smart about that, you can then tailor an experience for that segment you just learned about. So in some sense, it's a learning process, and there's no need to panic. Just respond appropriately. And I love what you just said about the agency it gives clients, particularly if you tell clients, hey, this is your agency. This is part of what we do for you. You can opt in and out of all of these various things. Some of these are going to be, default on. Some of these will be default off, and you can make any change that you want. And the clever advisor who's really thinking about crafting an experience is going to be smart about what they say default on, default off, because of course there's a behavioral economic component to whether people opt out of things they've been opted into and the like. So I think it's good advice, Dan.
It was really fascinating about this conversation. We talked a lot about feedback effectively, right? And for the advisor, and whether they go out and actively solicit it or it comes unsolicited, if you will, to them. And I think that's such an important thing. We've talked from a behavioral perspective, I imagine, for the advisors to become aware of and start thinking more about, because this is a real easy business to get complacent in, because it's recurring revenue business. Clients stay for a long time. It's really easy to have had clients for 10 years and to, as we talked about with Kieran Bull from Price Metrics by McKinsey not too long ago, that many advisors aren't really actively growing their business. They're kind of stagnant. They're adding onesie twosies through referrals, but then they're not bringing on big. So the feedback loop isn't necessarily coming from new business coming in and they're having to adjust in the marketplace from a competitive perspective. They're just serving an existing body of assets and population of clients. And so getting active about this will help you kind of evolve the business. You might not be doing something that, hey, I've been doing this for 20 years, writing this newsletter update thing that nobody reads and cares about. I like it, but you might find that maybe the clients want something a little different. John and I were talking about in an earlier episode where some advisors still believe that their clients want paper updates. They want paper statements and updates. And the reality is like, probably not.
Right.
Uh,
There is a neat thing when I think about how to exactly sort of like communicate this. So um, Jeremy Walter's an advisor who writes occasionally, and I often find his stuff very thought provoking. And he wrote a great post called "Growing Small." The analogy he used was a rose bush. The way that you have a high quality rose bush is that you don't let it kind of like sprawl out of control, and it actually will get spindly and thin and the roses will be smaller then. You have to keep pruning and keep trimming it. And in that way, you'll actually like the next year it comes back and it's going to be thicker and fuller and have prettier roses. And there's this duality of kind of refining your service over time to be specialized and niche so that you have skills that aren't generic, that
mm,
you have like a very clear, this is who I serve so that it's better for referrals and marketing and so on. And I think that's very good. I think the flip side of it that I don't know anything about, but I'm very curious about is the how are we also setting that up to force ourselves to grow a little bit.
mm,
I'm lucky. I have quite a few friends who are 10 years older than me. And it's great talking to them because you get this sense of like, like, okay, there are some things that's going to be me in 10 years. Is there anything that I need to know now that's like, this is what sets you up to be good at that point in time? A lot of advisors, there's so many studies looking at like advisor, what I'm going to call homogeneity. Advisors like working with clients like themselves. This is okay as long as the advisor's client base is like served by that. But if you advisors are obviously a very self-selected type of person. We enjoy math and finance and markets and numbers and so on, and we often serve people who are a little bit less on that scale. And more that like an advisor does not take into account how their clients are different than them, the more there's sort of a gap of like,
mm.
you're not, number one, not really being, to your point, an empathetic advisor and listening and hearing where somebody else is. You're also limiting your own growth to what is comfortable for you to extend. And that's a kind of neat challenge. There's this tension of like growing small, being high fidelity, quality in a small space, not trying to like end up sprawled with a lot of clients, but also thinking about what is the next, not like level, but the next segment of my career, and what am I working on today that's going to allow me to be where I'm doing something better or different. I've grown 5 years from now in with my client base or into a new client base.
Fascinating. It's funny. It reminds me very I'd had this in our show notes here for a little bit later on, but it does remind me, and I'm stealing your thunder here, John, of the online dating analogy that you used or in our prep call in terms of how do you attract high quality clients, right? That it's not enough for you to put on all the makeup, if you will, and take a really bad selfie of yourself to that's false advertising to attract, to attract, right? You need to make sure you're matchmaking for the right things. You referenced the movie, I think, Must Love Dogs, I think is what the one.
Love
Which,
it.
by the
Yeah.
way, good movie. I actually watched that. It's funny
Good
when you
movie.
brought that up. I remember watching that on an airplane once. It was one of those airplane movies. But that's a fantastic concept of, hey, be overt and very candid about what are you looking for your clients. It's not enough we just had Nick Cantrell and James Katz on. Nick Cantrell does Green Future Wealth Management, and James Katz was Humankind, an investment firm. And we're talking about ESG investing. And so it's very clear what those guys do. Like, if you're this type of client, you're looking for that type of business, be very specific about it, as specific as you can, and be active about it and so forth. What are some of the things that you see working there that in the industry that advisors are doing to make sure they get the right clients?
Mhm. I think this is almost one of the biggest hallmarks or litmus tests of sort of like maturity is being able to have a comfortable conversation about why it's not a good fit. And it even can feel uncomfortable just saying that
Mm,
out loud, right? Like nobody wants to reject somebody, nobody wants to feel bad about it. But so dating usually the end of it is marriage if you want to go that way. And a lot of time we have this very idealistic thing about like finding the right person, blah, blah, blah. But really what it's about is like finding a reason why the answer is no.
Mm.
And if you want to be really efficient at it, it's about finding the no as quickly as possible until you've kind of exhausted all the things. And you're like, well, I don't have any reason why not to anymore. Um, so I think the advisors who are good at this are very comfortable kind of going out and being like, why should we not work together? What
Mm.
are you looking for somebody who is I'm gonna do this for my software sake. Are you looking for somebody who's gonna send you like daily market updates? I don't do that.
Mm.
Are you looking for somebody who's going to like go into performance attributions and factor models? I don't do that. Um, and being very comfortable and like it's fine to also promote like what you do, but you want to have that kind of like, what's the best reason that like we shouldn't be working together here? Let's try and find where we're not aligned. And if we can find that, number one, I've avoided it, but number two, I can probably find you somebody else to refer you to who would work for you. There
I
is
love that.
a wonderful diversity and plurality of advisors out there, and we generally are aware of each other. And I know, if I have a client who comes and says, I really want like an advisor who's going to talk to me about a pot of 20 to 30 single name stocks, like it ain't me, but I know people who do that. And I would be happy to
Mm.
like pass you along. Getting comfortable with that idea of like, why should we not date? Why should we not get involved? And politically running that it saves so much time and heartache rather than like, let's see if we can work together and maybe I can change your mind about your core held beliefs later on.
I think calling that out as a mark of maturity of really of the practice more than anything else is really smart, because I think the life cycle you see frequently is I start out, I'll take anyone who will work with me, I'll take. Eventually, as I get a little older, a little more experienced, I figure out what I like and what I'm good at, and I start to gravitate more toward that, and my book starts to head in that direction. And somewhere in there, the best advisors start to figure out, I just can't take everybody anymore. I need to take the folks that fit this new model, and the very best can articulate it clearly, crisply, and really do dig in for all of the reasons that it's a good or bad fit, and then can have that conversation elegantly. That's a tricky conversation to have.
Yeah.
And it does take a little bit of courage, right? To be looking somebody in the eye and say, listen, I just don't think I'm a very good fit for you. As you said, that can be uncomfortable, but I think it is the mark of maturity of a practice.
I think it also there's definitely the level of the term that sometimes uses firing a client. And getting to that point where you're comfortable doing that is definitely one level. And then the next level is I want to set you up with somebody else
Mm.
because you as an advisor are going to have so much a better understanding of where this person would be a good fit. Right. Like being a normal consumer in an expertise marketplace, once you found somebody and you kind of trust them, it's very, I don't know, it's like bewildering to say, okay, wait, I had this thing and now I've got to start again. And I don't know where to look. I don't know where to go.
Mm.
So being able to say, this isn't perfect, but I want to set you up with someone. I'm going to help you transition I'm going to talk to them. I'm going to offboard you. I'm going to make sure that they understand all the key things that you need to do. And you are going to have a much better time with them than you're going to have with me. That is, tier level maturity in the relationship. And it also allows you to, other advisors will be like, thank you so much. That was great.
That's
I
right.
just got like the most seamless onboarding and nice intro. And they're going to have the exact same thing. They're going to see that as a like, wait, we can do this. You just showed me, through example, how to offboard the clients that I don't really have a good fit with. And if they're a good fit for you, they're coming your way.
That's fantastic. It's fantastic. Well, Dan Egan,
It's good stuff, Dan.
yeah, this has been a phenomenal conversation. I learned a lot. I had a great time, by the way. Also, this was just all the better. People are going to want to follow up. 100% guaranteed. They're going to want to read your blog, which is dpegan.com. And make sure we get that linked up in the show notes. If someone else wanted to follow up with you, what are some of the best ways for them to get in touch?
Yeah, probably. I'm on Twitter at Daniel_Egan. That's usually the easiest. DMs are open. And through that website, I think my email's publicly posted there. So feel free to get in touch.
Fantastic. Well, thank you very much for coming on the
Great
Augmented
stuff.
Advisor podcast. It's been great having you.
My pleasure.
Thank you very much for listening to and or watching this episode of the Augmented Advisor podcast. It was fantastic to have you with us. I hope you enjoyed the conversation as much as we did. Huge thanks to Dan Egan from Betterment for joining us and sharing his deep mind thinking. It's really cool anytime you get an opportunity to talk to one of the world's leading experts on a topic. So this did not disappoint at all. Thanks, Dan. I really appreciate you coming on the show. As I mentioned at the top of the show, please make sure you subscribe to the podcast on your favorite podcast platform. And do us a favor, make sure you follow Blue Leaf on LinkedIn and Twitter and Facebook, and subscribe to the YouTube channel, okay? We would love to have you be a part of our community. And by the way, if you like this episode of the show, please give it a share. Chances are somebody in your community likes it as well. So click that little share button on all of those things and, let the world know about it. All right. That's it for today. Please make sure you're staying safe and be nice to each other. We'll see you next time on the Augmented Advisor podcast. See ya.